In this video, I am going to be sharing with you a complete ultimate trading candlestick pattern that you ever need. If you can be able to master these candlestick patterns that I'm about to share with you in this video, then you'll be able to read any price chart. Candlestick pattern was established or invented by the Japanese. They use it to trade the forex market in the olden days, and right now candlestick pattern happens to be one of the basic things needed in technical analysis by price action traders. So candlestick will help you to be able to understand the price chart. It will help you to read and analyze the price chart, and it will also help you to have an entry trigger. It will help you to have a sniper entry. So my advice to you guys is to watch this video from the beginning to the end and do not skip any, so that you will understand everything about candlestick pattern. So in candlestick pattern, there are so many candlestick patterns that we can find in the forex market. There are so many candlestick patterns in the forex market. So I'm not going to be listing them one after the other for you, because some are relevant while some are irrelevant. What do I mean by relevant? What I mean is that some are highly reliable while some are not. So in this video, I'm going to be sharing with you 7 candlestick patterns that are highly reliable. If you can be able to master these 7 candlestick patterns, you'll be able to read any price chart at all. So like I said, the essence of understanding a candlestick pattern is to be able to read a price chart, to be able to analyze a price chart, so that you have a sniper entry. So we're going to follow this candlestick pattern one after the other. We have the bearish reversal candlestick pattern, and we also have the bullish reversal candlestick pattern. So candlestick pattern helps you to know when a new trend is about to begin, or when a market is about to change direction. So we have the morning star, we have the bullish engulfing pattern, we have the hammer, we have the doji, we have the evening star, we have the bearish engulfing pattern, and we have the shooting star. So I'm going to make everything simple so that you understand candlestick pattern. So many people will be teaching you candlestick pattern, but they will make it difficult for you to understand. So that is why I want to simplify this candlestick pattern, so that you know how it actually works. So we are going to follow them one after the other, so that you understand everything that I'm talking about in this video. So the first candlestick pattern we're going to talk about here is a bullish reversal candlestick pattern, and that is the morning star. The morning star is a bullish reversal candlestick pattern. It tells us that a downtrend is over and a new uptrend is about to begin. So if you look clearly on the chart, you understand what I'm talking about. So formerly the trend was down. That is why you see this big red candle. And after that, we have what we call ranging market, which is called indecision. So this is a doji candle. So a doji candle is an indecision candlestick. So before was a downtrend, which is this big red candle, and after that we now have ranging market, which is this small candle, indecision. So after that, what happened again? We have this a big bullish candle, which tells you that the buyers have stepped into the market. So once you are able to spot this candlestick pattern on a support level, once you are able to spot this candlestick pattern on a support level, you know that the bearish trend has ended, the downtrend has ended, and a new uptrend is about to begin. So like I said, the candlestick open here, close here, and then we have another open here, then went down and then close here, and then the buyer step in and push it up. So the sellers were active here, they open the market from here, push it down all the way to this point. So the market open here again, and then the seller push it down to this point. The buyer step in, push it up again, and then push it to this point until it closes above here. So this candlestick pattern is known as a morning star. It is a bullish reversal candlestick pattern. So this candlestick pattern works when you identify them at an area of value. So since it is a bullish reversal candlestick pattern, where you are likely to identify this candlestick pattern is at a support level. So once you see this candlestick pattern at a support level, you know that this is what we call a morning star. It tells you that the sellers are not able to push the price down and the buyers have stepped into the market. So once this candlestick pattern form, you wait for this green to close, and once this green candlestick close, you place your buy trade and your stop loss should be below the support level. So like I said, this candlestick pattern should only be make use of at an area of value. You don't need to spot it any other place apart from an area of value. Another candlestick pattern we have is what we call the bullish engulfing pattern. The bullish engulfing pattern is also a bullish reversal candlestick pattern. So it tells us that the sellers are not strong in the market. They are not able to push the price down. So that is why we have what we call the bullish engulfing pattern. It is a bullish reversal pattern which tells you that the buyers are strong in the market. So if you watch this chart very well, this is what we call the bullish engulfing pattern. So where do you identify this candlestick pattern? You identify this candlestick pattern at an area of value which is a support level, right? So when a trend is going on and the price gets to a support level, you should be looking at a bullish engulfing pattern. So once you identify this candlestick pattern at a support level, then know that the downtrend is over and a new uptrend is about to begin. So you can clearly see that the price opened here. Formerly the sellers were in charge of the market, pushing the price down, right? So that is why the price opened here and went all the way to this point. Then what happened? The buyers now step in. Once the market got to a support level, the buyers now step in and then push the price up to the extent that the price engulfs above this red candle. That is what I call it, a bullish engulfing pattern. It tells you that the buyers have stepped in, that the buyers are most strong and active in the market. So how you trade this pattern is you wait for this green candlestick to close and you place a buy trade at the close of this candlestick, and then your stop loss should be below the support level. And like I said, you must spot this candlestick pattern at a support level, an area of value, because if you spot it at a support level, it will give you a high probability trading setup. So it works extremely well at an area of value. So that is why I say you must have to identify this candlestick pattern at an area of value, which is support level. The next candlestick pattern we have here is called the hammer. The hammer is also a bullish reversal candlestick pattern. It tells you that the buyers are strong in the market, that the buyers are very active in the market. So the hammer tells you that the sellers are not able to push the price down, right? It tells you that the sellers are not strong enough to push the price down and the buyers step in and push the price up. So it tells you that the buyers are very strong in the market. So let me give you an example of how a hammer looks like, so that you, whenever you spot it in a chart, you'll be able to recognize it. So this is what we call a hammer. A hammer is a bullish reversal candlestick, right? It tells you that the sellers are weak, they are not able to push the price down, and the buyers are strong. So that is why you get this candlestick pattern. Formerly the price was in a downtrend, right? And when it got to a support level, what happened? The price got rejected. So that is why you see this long wick, right? That's why you see this long wick, right? Formerly the price was going down, the sellers were active, they were pushing the price down, and when the price got to a support level, right, what happened? The buyers now step in when the price got to a support level. So the buyers now step in when the price got to a support level and push the price up to the extent that the price closed here, forming this wick. So once you identify this hammer on a support level during a downtrend, know that the trend have changed direction. So you simply wait for this candlestick to close for you to place your buy trade. So once this hammer close, you place your buy trade here, and your stop loss should be below the support level. And like I said, you must identify this hammer at an area of value which is a support level. So once you identify a bearish movement, the market is clearly in a downtrend going down, and then you spot a support level, right? Once you spot a support level, then what you are waiting for is this hammer, right? For the price to break below the support level and then get rejected, forming this hammer. So when that happens, it tells you that the sellers are weak in the market. They are not able to push the price down, and the buyers have stepped in and they are going to push the price up. So that is what the hammer is telling you. That is how you rate the hammer. So the next candlestick we have is what we call the Doji. The Doji is an indecision. It tells you that either the buyers nor the sellers are in charge of the market. So Doji is an indecision, right? So once you spot a Doji candle, it means that both the buyers and the sellers are equilibrium. So that is when you identify a ranging market at either the support level or the resistance level. So Doji is an indecision candlestick pattern. Neither the buyers nor the sellers are in charge of the market. So once you identify a Doji, it means that the market is clearly in a range. The buyers and the sellers are exchanging prices. The market is in equilibrium. So this is an example of how a Doji candlestick pattern looks like, so that whenever you identify them, you can be able to recognize them on a price chart. So this is what we call a Doji. It looks like a cross. So whenever you spot this type of candlestick pattern on a price chart, it means that there is an indecision in the market. Neither the buyers nor the sellers are in control. The buyers and the sellers are in equilibrium. They are struggling for supremacy. So this Doji simply simplify that the market is clearly in a range. So once you identify this, it means that the market is in a range. So if you watch, you see that this is the highest point that the market got to, and this is the lowest point that the market goes to, right? So you can clearly see that the buyers and the sellers are in equilibrium. The buyers came into the support level, they pushed the price to resistance level. The sellers came into the resistance level and pushed the price back to support level. So you can see the price goes up and down, up and down, up and down, until the price finally closed, because the price opened here, went up, went down, and then closes here. So once you identify this plot sign, it means a Doji. It means that the market is clearly in an indecision. Neither the buyers nor the sellers are active in the market. So once you identify this Doji, you don't have to do anything, right? You can either trade the support and resistance level if there's a space, but what you are waiting for right now is the next candlestick, right? So if you see another candlestick that goes up, like you see a bullish candlestick, it tells you there is a reversal. Like if the market is clearly in a downtrend and then it forms a big red candle before this Doji, right? The market was clearly in a downtrend and then formed a big red candlestick telling the market is in a downtrend. Then after the big red candlestick, you now see this Doji. The Doji now forms, right? So at this point, it tells you that the market is clearly in an indecision, because clearly the market is in a support level, right, and form this Doji. So it means the market is clearly in indecision. The buyers and the sellers are in equilibrium. The market is ranging. So what you're waiting for, you're waiting for a big green candlestick to form after the Doji, right? So when a big green candlestick is formed, it means that the bullish has taken over. The buyers have stepped in and they are going to push the price up. So Doji means indecision. In this period, you don't have to do anything. So this is how the candlestick pattern works. So after that, we move into the bearish candlestick pattern. So the bearish candlestick pattern, we have what we call the evening star. The evening star is the opposite of the morning star. It tells you that the buyers are weak. The buyers cannot push the price up, right? It tells you that the sellers are strong. So evening star is a bearish reversal pattern, right? It tells you that the sellers are very strong in the market. Tells you that the buyers cannot be able to push the price any further. So that is what the evening star tells you. So here is an example of how the evening star candlestick pattern looks like. So this is how an evening star candlestick pattern looks like. First, the buyers were in charge of the market, and then what happened is that the Doji sign now formed, telling you there's indecision in the market, and then suddenly the sellers step in and then push the price down. So formerly the price was in an uptrend, and after the price got to a resistance level, it formed this Doji, telling you that there's indecision in the market. And after that, the sellers now step in, forming this red candle, telling you that there is clearly a reversal in this market. So this evening star is a bearish reversal candlestick pattern that tells you that the buyers are weak and the sellers are strong. So you simply wait for this candlestick to close, and then you place your sell trade. Then your stop loss should be above the resistance level. So this is how you trade the evening star. The next candlestick pattern we have here is what we call the bearish engulfing pattern. The bearish engulfing pattern is the opposite of the bullish engulfing pattern. It tells you that the buyers are weak in the market and the sellers are strong in the market, right? Because it is a bearish reversal candlestick pattern. It tells you that the buyers could not be able to push the price any further. Instead, the sellers are more stronger in the market. So that is what a bearish engulfing pattern tells you. So here is an example of how a bearish engulfing pattern looks like. So this is what we call a bearish engulfing pattern, right? Formerly, the price was in an uptrend. You can clearly see that the buyers were in charge formerly. That is why you see this big green candle. So what happened when the price got to a resistance level? The sellers now step in and then push the price down to the extent that the price engulfs below the green candle, telling you that the sellers are more active in the market. So once you identify this bearish engulfing pattern at a resistance level during an uptrend, it tells you that the sellers have stepped into the market and they are going to push the price down. So you simply wait for this red candlestick to close. So once this red candlestick closes, you place your sell trade and then your stop loss above the resistance level. So have it at the back of your mind that you only identify this candlestick pattern at an area of value, right? So this bearish engulfing pattern should be identified at a resistance level during an uptrend. So once you identify this bearish engulfing pattern at a resistance level during an uptrend, it tells you that the buyers could not be able to push the price any further, and that the sellers have stepped in and they are going to push the price down. So it tells you a reversal, a trend reversal from an uptrend to a downtrend. So that is what the bearish engulfing pattern tells you. So the next candlestick pattern we have here is what we call the shooting star. The shooting star is an opposite of the hammer. So it tells you that the buyers are weak and they are not able to push the price up. It tells you that the sellers are strong in the market. It tells you that the sellers are very active in the market and that they are going to push the price down. So that is what the shooting star tells you. So the shooting star can be identified at a resistance level during an uptrend. So this is how a shooting star looks like. So once you identify a shooting star at a resistance level, then know that the price cannot be able to go up again. So this is how a shooting star looks like. Formerly, the price was in an uptrend, right? The price opened here and then the buyers pushed the price all the way to this point, right? So what happened when the price got to a resistance level? The sellers now step in and then push the price down, right? So that is why you see this rejection candle. This is what we call a wick, right? This is what we call a wick. You can see this long wick. This is a rejection from the sellers. The sellers are pushing it down, right? So the buyers push it up to this point and the sellers came and push it down. So once you see this long wick, it tells you that the buyers are not able to push the price up. Rather, the sellers have stepped in and they are going to push the price down. So once you identify a shooting star at a resistance level, it tells you that the buyers are not strong enough. They are not able to push the price up. It tells you that the sellers have stepped into the market and they are going to push the price down. So once you spot a shooting star at a resistance level during an uptrend, know that that uptrend has come to an end and a new downtrend is about to begin. So you simply wait for this shooting star candlestick to close and then you place your sell trade and your stop loss should be above the resistance level, you must wait for the candlestick to close, the shooting star candlestick to close. Then you place your sell trade at the close of the candlestick, and then your stop loss above the resistance level. So this is how you trade a candlestick pattern. So simple. So if you are able to master these candlestick patterns that I've listed for you in this video, then you will be able to trade the Japanese candlestick pattern profitably. Like I said, there are so many candlestick patterns, but the ones that I've listed for you are the most reliable ones, the ones that are more reliable. So my advice for you guys is to go to your demo and backtest this strategy so that you will be able to trade them live on a real account. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be notified whenever I publish new content. I will see you again in my next update. Bye.